morning, everybody. I'm Josh Juergensen. I've been with CLA for about 15 years now, always on our audit and consulting side. So I've been a part of a number of transactions and due diligence engagements throughout my career, and David and I are really looking forward to chatting with everybody today. It's great to see a lot of familiar faces, many of which we haven't seen in a while here, but our hope is to try to make this as interactive as we can. We've got some spots in here that are talking about topics that I'm guessing many of you all have experienced throughout your careers, and if you're more than willing to share some of your stories, the do's, the don'ts that you've personally experienced, every one of these deals that we're a part of takes a different course of action. So if there's things that you feel so inclined to chime in on and add your 2 cents, we'd be more than receptive to that. So Dave, do you want to introduce yourself quick?
Yeah, so for those who don't know me, I'm David Heneke, been with the firm about 16 years and work a lot with Josh, like he mentioned, on an assurance and different consulting engagements. And this is a really, as it goes without saying, unique time in the M&A world, as already mentioned by a lot of the presenters. And hopefully some of the information we can talk through will give you some insights as to what's happening at the community bank level from what we're seeing there. That's coming up as a part of due diligence engagements, and what's causing problems, what's causing headaches, so that you guys can cut those off at the pass before you get too deep down the road.
There should be printed out slides on your table. For some reason, either the font didn't show up or I didn't save it right, but it just has got our logo on there instead of the do's and don'ts. So apologies for that, but there are printouts there if you guys need those. So as far as we're going to cover, kind of understand the value of it. We call an integrated due diligence process, and the importance of making sure that a variety of facets that we're going to touch on here today are integrated and done throughout the course of that due diligence. Provide some insights into, like I said, the experiences of things that we've experienced with clients, throughout the number of these types of engagements, and then finally, the valuation model and discussing some insights there as well. So, quick question for everybody: how many individuals have gone through some kind of acquisition during your tenure at your organization or existing tenure, or at other organizations? So, pretty good representation here. Not going to put anybody in the spot right now, but like I said before, if there are things that you want to share, what went well, what didn't go well, what things are tips that you've learned throughout some of these experiences, we're all ears for those as well. All right, now the topic of the integrated due diligence, on the I guess left side of your screen, we've got a number of different things that are listed there that you can see. We're going to touch on and go into detail on some of these things. As an example, we're talking about the credit risk side of the due diligence process, some of the things that are important to keep in mind and to make sure that you're not missing out on. There's also a couple at the bottom here. I'll say the middle, the reputation and cyber risk. Those are two areas that can be very easy to be forgotten as you go through that. A lot of times there's a lot of focus that's placed on the structure of the deal. A lot of time and effort spent on the credit risk and the financial risk, things that are very easy to be top of mind. But it's important to make sure, especially with things going on in the cyber world right now, that there's a clear understanding of cyber. We're going to go into some more details on that. On the right side of the screen, we've got some things that are actionable items that you need to make sure that you're taking into consideration on. Obviously, before you get to the due diligence process at all, there's a lot of time spent on identifying and assessing the risk of the opportunity that you may have. But it's also important to make sure that you're considering the synergies that are out there as well. How much overlap is there, whether it's through staffing, whether it's through strategy, whether it's through the credit portfolio, and how does that match up with your portfolio and your strategy and your organization? So as we're talking about how it's important to make sure these are integrated, there's a number of things that as you're putting together your due diligence checklist, your due diligence plan, that you've got a lot of these things included in here as well.
And I would also add that before you really even get to this point, one of the common things that we're seeing some clients struggle with when it comes to the bid and getting to this table is understanding what you want your earn back to be and what your rate of return is going to be on this acquisition. Because one of the things you're seeing right now a lot in the community banking space in particular, especially in smaller acquisitions, is the earnings power that's sitting behind that organization and where they're located and the growth potential, a lot of times does not really equate to a really strong earn back, meaning like how long it's going to take you to earn back your purchase price. And that's something you need to get comfortable with as a management team and as a board to understand what you're willing to accept there and how long you want that earn back period to be. I mean, we've seen a number of situations recently where I've had clients bidding on banks, and what I've thought has been a very healthy and high premium that would be a 10 to 15 year earn back, and they're not even getting to the table of the final two. And so there's, I guess a friendly way to shape that would be there's a lot of strategic maybe acquisitions going on of where people may be overpaying for the location or just wanting to win something. We also call it, there's like second place syndrome of where you finish second enough in some deals that you just want to get one, you just want to win one. So it's important to kind of set that framework so that you don't go beyond that and get yourself caught up in paying more than you're willing to do or willing to as a part of what that earn back will be. It's pretty prevalent right now, especially in the small banking space, and I think a lot of that has to do with just the dollars that are being thrown around just aren't as big as some of the publicly traded deals you're seeing there, so there's a lot more people that can afford it. But it's important to understand the mechanics of that, of what you want as your rate of return, because in some situations, depending on what you bid, your rate of return may be no better than a normal loan that you can go out and originate. So keep that in mind as well as you're starting to build out the framework.
David, I think it's also fair to say too that we've seen a little bit of pent-up demand over the last few months as we've gotten into the summer, and not that we're removed from COVID yet, but we're getting further and further removed from the peak of things. You go back to the beginning of 2020, there were a number of deals that we were a part of, or clients we work with that had deals in place that all of a sudden the pandemic hit and everything stopped. Those planned transactions that stopped and didn't happen for the last 18 months are starting to resurface again, starting to pick back up, and we're seeing more and more bidders that are coming to the table. To David's point, that second place syndrome is a huge thing that we're seeing in conversation with clients too. So before you even get to the due diligence side of it, there's a lot of those things to keep in mind. A couple of other areas just to make sure that as we're talking about integrated due diligence, the importance of taking into consideration the entire organization. HR, the impact that has, and we're going to go into a little more detail there. The accounting considerations, the valuation modeling. There's a lot of these types of things that we want to make sure that are top of mind, and not just a singular focus on the financial side of it or the credit, because those are two areas that are so frequently at the top of everyone's mind. And then last but not least, it's a second bullet point there, but the regulatory considerations. Make sure you're being proactive in those discussions with those regulators as well.
So it somewhat goes without saying, part of this will be stating the obvious, that evaluating the credit risk of who you're acquiring is very significant. And there's several things to consider now that maybe go beyond the typical scope of what you would do from a credit risk perspective. The big thing is obviously evaluating the underwriting and making sure that it fits with your culture of how you underwrite loans. I think Josh and I can tell numerous stories to where we've been involved in a due diligence project for a client, and they want us to go in and evaluate the underwriting. And if you get into an institution where you're looking at the loan files and you can't come to a credit determination, that's usually a big red flag, right? There are a number of situations that we've seen like that because there's just varying levels of sophistication when it comes to the underwriting with a lot of institutions. And so you just want to make sure that it looks like it'll fit into your culture. We're going to talk a lot about culture here a little bit later, and because that cannot be understated. It can be very hard to integrate the broader culture in general, but it's also very hard to integrate the credit culture of an organization if they're maybe a little bit looser with underwriting standards or compared to you, or maybe they're a little bit tighter and they can, there's maybe opportunity for growth there if they're willing to loosen those standards a little bit. So getting a grasp of that underwriting, having people help you or consultants help you if you need that is going to be very important, because that's going to be a big part of this. What's their problem loan management system look like? How aggressive are they in charge-offs? How aggressive are they in risk rating things? Because this tends to be one of the bigger problems when it comes to the evaluation of credit risk, is the number one thing you're going to want to look for is, are there landmines somewhere that have not been identified? Because if there are, that has kind of far-reaching ramifications within the subsequent accounting that results from acquisitions, and also just the ongoing operational management of that portfolio. It was interesting when we look back at the real estate lending crisis back in 2010 and 11, and a lot of failed bank acquisitions going on, right? The FDIC assisted transactions. Banks that did those were getting a really great price, obviously, because the banks were having trouble. But what I found interesting in my clients that did those and kind of doing a post-mortem on those situations is just the amount of time, energy, cost that went into managing the problem assets. And now that's obviously a very extreme example compared to the typical bank acquisition, but I think a lot of my clients severely underestimated that, part of which why they got such a great price, right? I mean, the FDIC was paying them to take these banks in some situations, but in some situations it was warranted because of how much time and effort went into managing the problem asset portfolio. So keep that in mind.
David, one thing to add
Oh,
on
go
the
ahead.
problem loan management, make sure to take that into consideration when it comes to your final bid price. As you go through that due diligence, that can have a significant impact on what the final price that you're willing to put. You may get into there, whether you're doing the due diligence from the credit side with your own lending staff or your own leadership team, whether you're leaning on a third party to assist with that. Those landmines that David talked about can have a significant impact on what that final bid price can look like. So make sure that you're putting sufficient resource and spending the proper amount of time and not going in there and doing a quick and dirty check and putting a blanket approval on that, if you will.
Mm-hmm. And make sure you really scrutinize the language as to how these problem assets are treated from a standpoint of how the allowance comes over in a deal. And for example, or what I mean by that in an example, is that you may see language that doesn't take into consideration the impaired loan valuations that banks may need to have on those impaired loans and the specific reserves that are set aside. I can remember specifically one deal I was working on where the language talked about the fact that all loans were kind of being priced as is, and when they were talking about the impaired loans, the net book value definition of the impaired loans did not include the specific reserve, which then in that situation had a bank bid and got it at that price. On day one, they would have had to book those specific reserves as credit marks, which would have effectively increased goodwill, because the way the impaired loan was defined in the agreement considered net book value as the principal balance of the loan. And so scrutinize that language. Make sure you understand how the net book value of those loans is being defined, because you could find yourself maybe resulting in more goodwill than you originally thought, or more intangible. And that's really the goal of all this. You want to pay a fair price, but you want to try to mitigate the amount of intangible that goes on in your books to the extent you can, especially when it comes to these type of items. And then we have the credit mark. It's important to understand the credit mark is not your allowance for loan loss. Now, this is changing a little bit, and I saw we've got a presentation here a little bit later that's going to talk about CECL and how this is all going to impact this. It's going to impact some things to the good. It's going to impact some things to the not so good. But the first thing to understand is the business combination accounting associated with purchases is not going away. So therefore, you need to mark all your assets and liabilities to fair value, and that includes the credit mark associated with loans. Now, this mark's going to be made up of two items. It's going to be made up of your interest yield adjustment for, if you have higher rate loans, you're going to get a premium for that. If you have lower rate loans, you're going to get a discount for that. And then it's going to have the credit risk that's built into it that's going to be part of your fair value assessment. Now, that doesn't mean that it's different from your allowance. So under current accounting language, you're going to mark it to fair value, and there's going to be no allowance on day one under current accounting standards. What's going to happen under CECL is that credit mark that you identify as a part of this process is going to get dropped into the allowance for loan loss on day one. So it is going to simplify it. So the only discount that will be left is going to be anything you'll accrete resulting from those premiums or discounts associated with interest rate moves. Okay? But at current time, they are different. So there's no allowance. So if you did an acquisition tomorrow, there will be no allowance booked, and the allowance will just get built up over time as credit risk becomes more prevalent. But under CECL, that will change. So just keep that in mind, because if the accounting will change if you do an acquisition today versus an acquisition after January 1st of 2023. Okay? And we'll talk about that a little bit more, of some considerations to keep in mind in regards to CECL, because it will change. Even if you did an acquisition today, it's going to have an impact about 1.5 years from now. And I alluded to rate considerations already. And one of the interesting things that we're seeing right now is, I'd say, maybe 5-10 years ago, more close to 5 years ago, when you're doing that valuation, the discount that would come out of that computation, typically by miracle, was pretty close to your allowance. That was just kind of how it worked. Okay, so we were looking to see that we want the discount to be pretty close to the allowance on day one. Well, what's happening now recently, because of where rates have gone, and this may change if the Fed raises rates like they've been throwing around that they might, is that you've got a lot of banks sitting on loans that may have been originated 5, 10 years ago that have pretty good interest rates. And so we've seen some deals actually come through to where the rate premium, the premium being paid for the rate, actually completely overpowers the credit component of the discount, so that there's really a very minimal fair market value adjustment on day one. So have fun trying to explain that to your regulators, that you're going to book this all on day one, you're going to have no allowance basically at all for these loans, because we marked them to fair value, right? And so it's pretty interesting of what we're seeing right now. But then, if rates go up sometime in the future, you'll see those discounts begin to come back, because those rates will be at higher rates than what the portfolio is showing. So that's just something to be aware of. Be aware, fixed versus variable is another consideration. How much of the portfolio is fixed rate? That could cause us problems depending on where rates move in the future. How this fits into kind of your asset liability management. Those are also things to consider. Collateral values goes without saying. What is their policy surrounding collateral values? Is it different than yours? Are they willing to go higher on loan to value when it comes to originating loans, or is it pretty consistent to your credit culture? Make sure you maintain an understanding of that, and then also how they're evaluating the impaired loans, which we talked about already. Current financial information. What is their process and procedure and the requirements for obtaining financial information? Is it similar to yours? I can think, a few years ago we were on a due diligence project for a client. I remember opening up the first loan file, and the financial statement in there was from 3 years ago. We started going through more files, more financial statements from 3, 4 years ago. It was pretty clear that the underwriting function was not being very diligent in obtaining new financial information, and the answer we got is we know our customers will know if there's a problem. Okay, that might be all right, but obviously if you're the one buying it, you're taking on a certain level of risk when it comes to the financial information that these risk ratings are based on. So it's really more of a policy understanding when it comes to this, making sure you understand what the requirements are for the obtaining of new financial information. And as Josh alluded to earlier, when we're talking about this holistic approach and getting people involved from all areas of the organization, leverage that internal loan expertise. Have your chief credit officer involved, have your loan officers involved, have them look through these files, have them identify where there could be lumps. That's very important as a part of this process. And the other thing, just a little bit off topic here, but when talking about the credit mark, don't think that you're married to acquiring the whole portfolio if it comes down to a few loans that you and the seller are arguing over. There's a number of structures that you can develop to where they get carved out and handled in a different way. So it doesn't need to be an all or nothing. I mean, I've been a part of a number of deals to where, there's between 10 and 15 loans that the parties just cannot come to an agreement on. Saw one situation where they agreed, well, we're going to put all these loans in an LLC. The buyer is going to basically be on a first in, the first payments go to them, and then anything left over would go to the seller. That was a pretty effective mechanism, because obviously the seller thought the loans were pristine, the buyer thought, yeah, there's some hair on them there. But that was a good way that everybody was made happy. If they turned out to be pristine, the seller would be compensated. They turned it out to have some hair on them, the seller wouldn't be. So just keep that in mind as well. There's a lot of ways you can structure these different things. You don't want disagreement on a handful of loans to blow up an entire deal. It can be structured in a different way.
One other thing just to add, to a few of these bullet points, and it's not specifically called out here, but as we're in our various clients, whether it's a part of a financial statement audit or external credit review or these various services, we see a wide variety in loan policies. What are the underwriting standards? What are those loan to values? What's the frequency of financial information? And every bank's different on what they do from a tracking standpoint with policy exceptions. We've got some clients that have got very liberal policies, and so there's very few policy exceptions. We've got some that have very tight policies, and there's a lot of exceptions. Make sure that you're asking, let's see what those policy exceptions look like. This is something that we're continuing to see more and more the regulators pushing on, If they see that there are policy exceptions, they want to know what you're doing to track those. How many do you have? Is your policy accurately reflecting what your underwriting is? That's something important to keep in mind as well. When you're making your due diligence request list of a target institution, make sure you're asking for what do those exceptions look like so you can marry that up with what the loan policy states.
So the next area we want to talk about is this has gotten a lot more play over these last few years, and it's kind of Captain Obvious here, but these core contracts can become a huge problem in acquisitions. And I think I saw there was a session on these a little later, and I would highly advise you getting as educated as you can in this area. If necessary, bringing in a consultant to help with some of these items, because some of these the deconversion fees can be immense. I mean, hundreds of thousands of dollars. And who's going to be responsible for paying that as a part of this deal? And that's going to be all part of the negotiation, okay? But it cannot be overstated. Core contracts, lease agreements, are there any change in control provisions in employee agreements? Are there any stock option or equity plans? And then also ESOPs. This is another area. We have a few clients that do have the employee stock ownership plans, and how those get handled in the situation of a change in control. So these are some things that tend to get overlooked, not really the core contract anymore, because it's caused we've had deals that got torpedoed because of the issue with the core contracts. And this also goes, this is the due diligence do's and don'ts, but if you're in an institution that's thinking about selling, you probably don't want to enter into a 7 to 10 year core contract agreement, because typically the deconversion fees could be in excess of $1 million in some of those situations. So make sure you understand that language. If you don't, if you don't feel you have the expertise in-house, go outside and hire a consultant. It'll be well worth the money when it comes to this particular situation. We'll talk about some HR things here a little bit later, but those change in control agreements, and if that triggers any type of payout for any of the employees, make sure you're aware of those, because in a lot of these situations, and what we're going to talk about a little bit later, I know it's accounting nerdiness, so forgive me, but the accruals and what should be accrued under generally accepted accounting principles needs to really be vetted. I've had a number of situations where I've had clients that have done an acquisition only to find out that there was an accrual that should have been accounted for prior to, which would then have reduced the capital in that organization, which then would have reduced the purchase price. So and a lot of these stock ownership plans and these stock deferred comp agreements, depending on the materiality level of them, a lot of clients or a lot of our banks don't book them, but they should be. And so it's very important to vet those out, because if there is a liability that should be out there, that's going to have a direct correlation to what the purchase price is.
Is anybody willing to share a doomsday scenario with the core contract, whether it's a thing you were a part of or something you were considering that maybe your institution walked away from?
Or just the negotiation with the vendor, that doomsday scenario?
I would just say this, we did one recently, and I would say we have an employee of 40-some years of experience. She trained Fiserv. Fiserv, the people on Fiserv to help with the core conversion.
Wow.
The hundreds of thousands of dollars is certainly accurate, but the people on Fiserv, which we are to help you, totally didn't know what was going on. And they only, of 10 issues they should have brought up, they only covered 5 or 6.
Yeah.
And fortunately, we had a well-educated gal who said, well, what about this, what about this, what about this? And of course, the things they didn't bring up, well, we can do that for 50 grand.
Yeah. Right.
Less than 6 figures?
Well, this
Inflation, right? That was years ago.
Oh, okay.
The other thing I would just say about the valuation thing, you were talking about earlier, I don't know, we just did one, and I think you have 12 months to get that done.
Yep.
So we closed the end of May. In June, the FDIC out of Kansas City called and said, where's your valuation? Within 30 days of closing. And so they're the regional
Julia Kuhn, yep.
So she called in June, July, August. We'll be done. We're ready to go here by third quarter call. But they're very aggressive in pushing to get things done instantly.
Mm-hmm.
Now, I think it's COVID. She didn't have enough to do. She had to go another. I don't know if others in the room have seen that same thing, or you guys have seen
Yeah.
that. They're pushing hard early.
Well, Well, and I have seen that personally, and I can tell you that it's interesting of how, what the accounting says, to your point about the 12 months, and then kind of how they view it, because I'll say from a technical perspective, you're supposed to have all that, kind of your preliminary fair value stuff all done right away and then book it. And then, as you mentioned, the standards give you a 12-month period to kind of go back and revisit and say, was there stuff that did exist at that date that we should have known and just didn't, because, things are going 100 miles an hour, and that allows you to go back and fix it. But you're 100% right. They're tending to seem to lean more to that, like, yeah, you should get the preliminary done as quick as you can, and then we'll sort it out on the back end for whatever reason. I would agree with that statement. Yep.
One other point that I'd make on the core contract piece, the first session today, they had a slide up there that kind of explained the timeline of a deal, right? And I want to say it was in the 6 to 9 month range. Once you've gotten the formal acceptance or past the due diligence process, one of the first calls needs to be to that core. We've got too many situations that we've worked with, and I don't know if there's a staffing issue, and this is even pre-COVID, but maybe you guys even have some experiences, but last I'd heard it's a good 6 to 8 months out before you can merge those systems together if you're on the same core. If you're not on the same core, it even adds more complexity to it. So make sure you're having that conversation as soon as you possibly can, or as appropriate. And
even in those situations, it sometimes doesn't help. I had a client that did an acquisition. They had the conversion set up for a weekend. It was they were going to do the conversion on a Saturday, and the core contract called them on that Friday before the Saturday and told them this verbatim, said, "We have a bigger client that needs our help. We're not going to be able to convert you tomorrow." So, to your point, you just got to be ready to adapt. Okay.
Our seller had negotiated declining fees, so it helped our seller in the process.
Oh, really?
So we're negotiating our core right now, not planning to sell, but the seller side of our core negotiations is a big part of our contract right now. Now that we bought one, we want guarantees.
Right.
Caps on fees, declining balances, we want all those things in the event we sell, which in our last contract, we didn't even consider until we've been through it. It's positioning the contract, even if you're not going to do it.
that's where it's so important. I mean, again, not necessarily do's and don'ts of due diligence, but even for your own core contracts, there's so much more to those contracts than just the fee structure of it. So make sure you're taking that into consideration.
Yeah. Yep.
David, we good here?
I think we're good here, yep. All right, so now we've got the valuation model, which we somewhat talked about a little bit, but you got to decide whether you want to do something internally or externally, and that seemed, at least in my anecdotal experience, depending on the size of the deal, if it's a community bank, I've found that the regulators are a little bit more willing to accept a more informal or internal methodology than actually having to hire a third party. Because as you can imagine, some of those things get pretty expensive. And when you're talking about a typical community bank deal, you're really talking about loan valuation, the building, and deposit core deposit and tangible are kind of the big three as far as those evaluations. And if it's a typical community bank with a pretty simple balance sheet, there's a lot of functionality in some of the freely available tools out there that you can do a pretty good assessment of what that valuation will be that'll satisfy the regulators. When I say freely available tools, Microsoft Excel. For those of you who know me, I'm a big Excel proponent, a big Excel advocate, because there's a lot of stuff you can do in there, particularly in this area. That's not too bad, and I guess we'll satisfy them, because the one thing I find interesting in these, a lot of the more complex valuation methodologies is the one thing we know about evaluation is it's going to be wrong. So we can start from that premise, right? We know it's going to be wrong, and so then it's a matter of degree, right? How close can we get? And a lot of the valuation methodologies are simply using kind of a discounted cash flow method, which is a fairly simplistic formula. If you guys do discounted cash flow every day when you're coming up with loan cash flow, and then it's just a matter of what are the inputs. It's a matter of what discount rate do we want to use from a standpoint of fair valuing this thing. So that I would caution you before you go down that path when you're thinking about how you value it. consult with your regulator, consult with your accountants to come up with the most cost feasible methodology to do this, because this can get expensive quick. And same with like core deposit intangibles. You pay 10, 15 grand in some cases to get an evaluation of your deposits when there's a ton of publicly available information out there about what core deposits as a percent of your transactional accounts are. And in a lot of cases, that'll be sufficient when it comes to that. So just make sure, before you jump in with 2 feet, just make sure you're having those conversations with those advisors to determine the best course of action.
David, one other, you talked the CDI is a big one. Another one that if the institution's got a big mortgage portfolio, those mortgage servicing rights are another one to keep in mind. It's an easy one to forget about too. So make sure that they've got the mortgage servicing rights recorded first off, second off, getting the valuation properly done on those MSRs as well.
Yep. So then we've got the various stages of due diligence. We just have them outlined here of kind of the preliminary, detailed, and final. You want to be tracking this kind of throughout the process, because where the rubber hits the road is you want to have a good idea of what those fair value marks and what the resulting balance sheet will look like at the end of the day. Because at the end of the day, how much intangible is there really has a pretty significant impact on your capital levels, your regulatory capital levels, because those don't obviously count towards regulatory capital. So make sure you've got a firm understanding of what capital levels you're willing to accept. Kind of when we were talking about rate of return, how low are you willing to go from a standpoint of those, the community bank leverage ratio for those of you who are on it. Will it put you below 9% to where you can't use it anymore based on an acquisition? So it's good to have, it doesn't need to be very refined at the beginning, but you want to have an idea of where you'll be when you reach the conclusion there. And making sure you have documentation for the board as well as management, the regulators, that you're going through all this stuff throughout the process. And I would just go back, valuations can be done 100 different ways, and just make sure you vet and do the one that's right for you, and don't spend more money than you have to on them depending on the size of the acquisition.
And I'd say just on that documentation piece, make sure you're being proactive in those conversations too, whether it's with your auditors. Make sure they're in support of the valuation approach that you're doing, whether you're doing it internally or externally. Generally speaking, as I see my accounting firm friends in the room here, usually we can talk pretty consistently with one another, and we're usually on the same page, but make sure that it is something, because the last thing you want to do is get to the end of the year and you're going through a financial statement audit and the valuation approach used isn't in alignment with what they would expect. So just be proactive in those conversations.
All right. So a couple of quick accounting considerations to be aware of and how they could impact diligence or a deal. We've alluded a little bit to CECL, and the main thing that I want to point out here is if you think about, if we're transitioning from the accounting now to what it will be under CECL, if we mark everything to fair value now, and then we get to that CECL area, you've got to now book a reserve for how much lifetime loss you think exists in that portfolio. So it is not beyond the realm of possibility that whatever credit mark that you have associated with that portfolio built in that discount will go up when you get to January 1st, 2023 for our calendar year reporters in here. So it's not something that should necessarily, tank a deal, but you need to at least get an understanding of what the CECL reserve in total may look like when you get to that date. So the good news is that there is going to be, the FASB is talking about potentially changing some things in the wording that may allow you to just debit that discount and credit reserve upon that transfer if you still got something in there. But that still doesn't mean, or on CECL implementation that is, it's not official yet, but they're talking about it. So part of that increase would just be handled by moving the discount over there. But does that number go up? Because that will be a direct shot to capital on that day, because you're going to be debiting capital and crediting reserve. So now there's some phase-in stuff for regulatory accounting purposes as far as your call report's concerned, but just be aware of that, because if we really undershoot that on day one, we may have some impact on the back end. Leases. I had a specific situation where we were looking at a bank to acquire for one of our clients, and they had a long-term lease that they were treating as an operating lease for financial reporting purposes. But but per the accounting standards, should have been treated as a capital lease, which would have accelerated expense recognition. That should have drove the purchase price down. Make sure you get an understanding of those lease agreements, the terms, renewal options, length, because it could, if they're not booking the accounting correctly, it could have led to lower capital and a lower income stream if they're not doing it the way it should be done. So make sure that you're aware of that. You know, taxes, kind of goes without saying, there's a number of ways that you can look at the tax treatment of a deal. You know, do you want to treat it as an asset deal so you can get the deduction associated with the premium? Or do you care if it's a stock deal where you won't get the deduction of the premium? You know, a lot of times you see that kind of balance out to where if it's treated as an asset deal, the price goes up because you as the buyer will get the deduction, whereas the price goes down in a stock deal where you won't get the deduction. So just make sure, you know, everybody's on the same page of what you want to do there. We've talked enough about the fair value accounting as it relates to the valuation, you know, so that's just make sure you're on top of that. And I did allude to payables. Make sure that everything that should be accrued is accrued, because you do not want to be left paying for something out of expense after the acquisition that should have been on the balance sheet on the day you bought them. So you want to be debiting payable and crediting cash as a part of that, as opposed to hitting expense for items that should have been the seller's responsibility. So looking at invoices, you know, contracts, if there's anything to where they're getting the benefit of that service right now, should be accrued.
I know we got about 5 minutes left here, so you know, we'll probably zip through these last couple relatively quickly, and I think they're pretty straightforward here. And we got to be out here at 11:45 because this is a lunchroom apparently. So we don't want to stand in
Speed
between
up.
you guys.
Come on.
Yeah.
Pick it up.
Reputation risk kind of goes without saying. Everybody understands what that is, but you know, one of the other slides that I made note of in that first session was, you know, whether it was the auction approach or a one-on-one approach to going out there and getting a bid, or kind of somewhere in between a moderate approach. That confidentiality piece can be so huge into these due diligence engagements. So making sure that there is that level of confidentiality, because all of these things we've got listed here, what's the impact in the institution's history within the communities that they're in? What kind of involvement have they had? What kind of expectations are there within the community from that particular institution that maybe you don't even have a tie into that geography you know, prior to the acquisition? So make sure that you've got a clear plan in place for how to handle those types of considerations. And then also taking a look at that institution's specific employment base. Are there people that you're going to need to or want to bring into your own organization? Are there people, you know, what are those cost-cutting opportunities that are there, and making sure that there's those conversations within your side as you're going through the due diligence process, because in a lot of situations, we're able to see the opportunity for good, talented individuals to be brought into your organization and supplement what you've already got there.
If I could add briefly there,
Yep,
Josh,
sure.
real quick, just a quick story. It kind of goes back to the culture and as it relates to that. I had a client that bought a bank that the underwriting criteria culture was not aligned, and to where the bank that was being purchased, the loan officers were bad-mouthing my client, the acquirer, to their community about loans that weren't getting done because of that misalignment, which has led to some, you know, pretty significant reputational issues within that community and their ability to grow. So that's just kind of a specific example related to that, of where the misaligned cultures is causing problems.
Cyber risk is one that continues to increase in you know, the amount of conversation we're having on that, and increase the level of risk. Making sure that you are leveraging the appropriate individuals, whether you've got people within your organization that can properly assess you know, the overall infrastructure from a cyber perspective. Making sure that as a part of your due diligence request list, you're asking for, you know, let's see the reports from your general controls reviews, your penetration tests, your vulnerability assessments, those specific kind of IT things, because, you know, ransomware is a topic that's not going away anytime soon. Making sure that there's those proper control structures in place, and you know what you're getting yourself into from an overall reputation perspective. You know, in most situations, from the cyber side of things, that can easily be forgotten because you're going to roll them into your own infrastructure, but knowing the history and the background there is important as well. And then I touched on this a little bit in the last one, but you know, what's their talented individuals like? Those cybersecurity individuals or IT individuals within community banking, it's difficult to find, as I'm sure you guys know, people that truly understand bank IT. And if they've got people that are in that organization that can supplement and support what you're already doing, you know, all the better. And then last slide here, human resources. David touched on some of this already, but make sure that you've got a strong understanding of employment contracts. Every institution is different as far as what the employment agreements are within, whether it's their lenders, C-level executives, what have you. So making sure that you understand what those contracts look like. Are there any termination penalties that are in those? Are there any stay bonuses or things like that that will come to fruition at the time of an acquisition? So make sure you've got your arms around what all those employment contracts look like. And then the last one, we touched on staff considerations too. So I know we zipped through those last few slides relatively quickly in the essence
And
of
if I could add
Yeah,
just
go ahead.
quickly on the stay bonuses and staff considerations, as you probably saw from the presentation this morning about current efficiency levels of organizations. One of the things that when people would go into an acquisition, maybe 5 years ago, is they'd say, oh, we're going to be able to bump that net income up because we're going to be able to eliminate a whole bunch of staffing, right? As we'll be able to cut a lot of people that aren't there. I would just say in deals that I've seen recently, the amount that you think you're going to be able to cut may not be there, as significant as it used to be, because just banks right now are generally running fairly lean when it comes to staffing. One, kind of out of necessity to kind of keep pace with the larger institutions, and two, because it's hard to find people right now. So just kind of keep that in mind as well when you're doing some of those projections of how much cost savings is actually there and you think you can carve out. So.
Questions at all? Comments? Anything? Anybody want to add? Yeah.
The selling bank wants to be compensated more than non-competes it has the executives and loan officers. Do you value that?
Yeah, so non-compete agreements are valued as a part of an intangible process similar to the core deposit intangible. And those would be valued, booked, and amortized off over the life of that agreement. So, yep, that's a good point. So one way that I've seen it done is you look at kind of the potential income that is being generated by whatever that agreement is, and then discounting that back at a discount rate. I mean, depending on the nature of what we're talking about, whether it's like an insurance agency type deal or a loan officer or whatnot, you got to come up with some assumptions about how much income that's creating, discounting it back and coming up with it. It's pretty, there's some data out there where you can find some percentages as a percent of different things, but that's a little bit more in depth than like a core deposit or a loan deal, to where you may, depending on how significant you think it is, you may need to bring in a third party. Good question though. That's another thing that's often missed is those non-competes, because they do have some value to them theoretically.
We are at 11:45, so in order to control the stampede into this room and get just let the staff clean things up. Dave and I'll be around all day today and tomorrow, so let us know if there's questions that everybody has. We'll be around. So appreciate you guys joining us today, and have a great rest of the conference.
Good luck acquiring. So.